Sean Peche, I'm feeling a bit sore this morning. One of my bankers in the BizNews portfolio is Netflix, and it's fallen like a stone to levels back in 2018. So you're buying Netflix today in 2018 prices, which I guess some people are running off and saying, this is good news. They want to buy them. My situation is, I'm not sure, but you wrote something this morning, which is kind of going to be shaping, I think, many people who are caught in this Netflix dilemma. There's once exponential stock that's suddenly gone X growth. And I love the way that you unpacked it by sharing on social media. Sean, do you do this often when by distributing your information? Obviously, Ranmore Funds has got its own clients, and you need to keep them informed. But sharing publicly, do you actually see this as a way of just engaging?
Do you know, Alec? It's quite a recent thing for me. I never thought I could write very well, and I've still lots of work to do. But a few years ago, I did a writing course. So I met a guy at dinner who's become a friend of mine, and his mantra was, I try and help people find their writing voice. And so I just really do it for a couple of reasons. One, I like teaching, and I think if I had to choose another profession, maybe I'd teach, because I enjoy teaching. And so whenever I bring young people into the business, I enjoy that part of it. The second part is it also helps me crystallize my thinking. And I think that's the important point. And as soon as you try and get something across to somebody, you got to make sure that you understand it really well yourself, so that you don't embarrass yourself. And so we don't own Netflix, and it was down. And I thought, well, let's just write a little note about it, because there are a couple of points that I wanted to make. And those develop as I was going through the process, and also, and I guess the other point is just to not enlighten, but to tell people that just because something is down doesn't mean it's value. Everybody confuses, the value guys, they just buy stuff that's fallen in a heap and horrible. No one wants to go there. And of course, we've been in the wilderness for many years, and now we're coming out of the wilderness, and value is performing much better than growth. And so that's the important thing: is okay, it's down 36%, but let's look at it. Is it value? Because if it's not value, I'm not interested. And the first point was, wow, it's still worth $100 billion, and that's a big number. And so yeah, so that's really how it all sort of started. And I get positive feedback via direct messages, and people find it helpful. And I also know that in this age of empowerment, people want to invest themselves, and that's great. So there will be some people who want to invest themselves, and it would be nice if I can help some of those people make a bit of money or not lose a bit of money. But then some people kind of leave it to the professionals, and so maybe there's a bit of marketing in that respect. So it's just trying to do my bit, really.
For those who haven't been following the Netflix story, they came out with financial results in January, which the market did not like. The share price took a tumble as a consequence of that, from around almost $700 a share to around $400 a share. And now they've come out with a set of financial results, which is even worse. And it's taken the share price down to 226 as of last night. So it's down, well, by 2/3. The bulls are saying exactly the point you made earlier. This has suddenly become a value stock. Why? Because Netflix is the same price it was when it started in 2018, which is 4 and a bit years ago. It's double the revenues of 2018, 4 times the earnings, twice the net profit margins, and 3 times the return on invested capital. So that's the bull argument. But you are saying, hang on a little bit here. That is actually not good enough for you. And in fact, you're not buying the stock. Now teach me, take me through, because remember, you're talking to a guy who was on the Reed Hastings train. I was up until I got a little bit dubious in January, but now completely dubious earlier this week. Everything in Netflix appeared to be the perfect exponential stock, which it no longer is, because you can't be exponential if you go X growth.
So, Alec, the first point, I mean, Reed Hastings has been a genius. If you look at where they've come from and how he's managed to reinvent the business from, taking the blockbuster model and posting people the videos, and they haven't fallen into the trap along the way. They've built organically. They have got onto streaming, etc. They've developed this market, but But there are a couple of points. I mean, the one is that as soon as you do well and you're demonstrating growth and you're demonstrating decent returns and you're getting a high value for that, you attract competition. And that's exactly what's happened. And so Disney thought, well, hang on, look at what everybody thinks Netflix is worth. We've got the content, we can do that too. And then you got Paramount saying, well, we can do that too. And Hulu, etc. And so they've attracted competition. And so they're almost a victim of their own success. So that would be the first point. The second point is it's always interesting to take a fresh look at it and say, well, rather than the share price is down 60% from its highs, maybe those highs were just ridiculously high. And so that's not a benchmark. And that's why I like to look at the value, in dollar terms and saying, okay, well, forget what it was. What is it today? It's $100 billion. That's a big company. There are lots of media companies that are way smaller than $100 billion. And then say, okay, well, what am I getting for that $100 billion? Well, I'm getting revenue of $30 billion. Well, that's 3 times revenue. So if you're paying 3 times revenue for something, then you should expect high margins. So what are the margins? Well, the margins, the operating margins are about 20%. Okay, so that's good. And they make, $6 billion in operating income. So now you say, okay, well, it's 100 billion, 16 times operating income. Okay, that's, but that's before tax and that's before interest. And you say, okay, well, that's okay. Maybe after interest and tax, we're looking at 20 times net income. Is that where we are? That's roughly where we are at the moment. But now comes the important part. Are those earnings cash? Have they been able to translate those through to cash? And that's where it got quite interesting, because then I looked at their cash flow statement and the cash flow statement was negative. And I'm going, well, hang on. Normally what happens in a business when you're slowing down, your cash flow comes rushing through, because all of a sudden, your accounts receivable is not expanding, so you don't have to invest in working capital. Your inventory is not expanding, so you don't have to invest in inventory. Of course, this is a different type of business because they have no inventory. And they don't really have accounts receivable other than, the credit card receipts from a few days before quarter end. And so that's why I started to say, and that's why I walked people through the process of saying, okay, well, hang on, why is cash flow no good? Because there's no inventory and there's no accounts receivable. And let's go and have a look at it. And then I looked at the balance sheet and you see $30 billion of content assets. And the movement of the content assets affects the cash flow statement. So while they're not investing in inventory, they're investing in content. They're going to make it The Crown and Bridgerton and all these other Peaky Blinders and all these other series. Ozark's brilliant series. If you think you're having a bad day, you're having a better day than Marty Bird, I tell you what. But anyway, so all this content costs a lot, and the problem is you're getting higher profile actors, and you've now got more competition because you're competing against Apple. And here's the big problem. For Apple TV Plus, it's a sideshow. They don't need to make money on that stuff, because they're making so much money on the iPhone and iPad and iWatch or whatever, or Apple Watch. And Disney doesn't really need to make money on Disney Plus because they make money on the parks and they make money on movies and all the rest. But Netflix has nothing else to subsidize, so they need to make a bit of money. And I've always thought that, there are probably a couple of other strings in their bow. They could do advertising. They can stop the sharing. And they're talking about that now. And I think they're going to have to look at that. So that's really how I evolved. But so it was looking at the content, looking at the accounting policies. And then when I looked at the content, and what's interesting is the content costs are going up. The amortization, it's a bit of a funny one, because you look at $30 billion, and so that is going to have to make its way through to the income statement over time, plus the content that they're continuing to develop. And so the income statement can vary because it's based on viewer patterns and expected viewer patterns. I mean, how many years should you amortize The Crown over? If most of the people have watched The Crown, is it worth anything now? It's only the few people who are joining Netflix tomorrow and who haven't watched The Crown and maybe want to watch The Crown. So the question is, well, what are those content numbers worth? We don't know. Are they worth 30? Netflixers think they're worth 30 billion, so let's take it at that. Well, the market cap's 3 times that. So you say, okay, well, then what am I paying the extra 70 billion for? Well, you're paying the 70 billion for their loyalty and their brand and all the rest. Well, people can leave Netflix tomorrow and sign up and Apple, and then Netflix gets in the game of saying, "I'll tell you what, come back to us and we'll give you a free month," and that's a bit of a slippery road. So I always, sometimes I just find when it's tricky, I stand back and I say, are conditions getting better? And if conditions are not getting better, I'm not interested. It's only when conditions are getting better and it's cheap that my interest is piqued.
It's a compelling argument. On the other hand, you have seen continued growth, and they are growing well outside of the United States. That was the one thing. The thing that there were the two arguments that I'd love you to just apply your mind to. The one was Reed Hastings has always said, I don't worry about competition because our competitors are free-to-air television and network television, and they're still much bigger than any of the streaming services are. So that was the one point. And the other point that he has been talking about, which I completely buy, is that because they have a global footprint, they're producing content in local markets, which goes global. You take the Squid Game, the Korean one, which was a relatively low budget movie, but a fantastic hit for Netflix, and presumably would have added quite a lot of subscribers. Those 2 points have always been the areas that if you listen to Reed Hastings, the creator and the CEO of Netflix, they've been enough for you to believe. I guess your insights on those would help to inform many of us on whether or not we were placing too much emphasis on it.
Yeah, and I think that's been an incredibly good strategy. I mean, you look, there was another one, Lupin, and which the French detective, and so they need those. And actually, if you look at companies like ITV and those guys, one of the cheapest forms of content is unscripted content. I mean, take Love Island. You put a whole lot of good-looking people in a Mallorcan villa. You dangle £50,000 as the prize, and you pay to rent the villa for 2 months. And those are your costs, really, other than a stacked bar fridge and a few camera people.
What you watch in your spare.
So I hear, Alec. It's got to be a lot cheaper than to try and do a period piece like Bridgerton. I mean, that's an expensive series. So, but the problem is they're hamsters on a wheel, because you can't just hook onto one content and then forever repeat it. You've got to keep coming up with the next thing. And what worries me is that the content costs were going up, even though we had Squid Game, even though we had Lupin, and things like that. And I think it's probably because of the competition, because everybody knows that unscripted is cheap, and so everyone's trying to escape to the chateau and do a Love Island or do a Voice or Britain's Got Talent, that kind of thing. And I love the product, but just because I love the product doesn't mean I have to own. I mean, I love my mattress. I don't have to own a mattress company. So that's the one point, I guess. And so it might be a great company and it might have wonderful prospects, but the next question is, can I make a return? And that's where value investors, I think, spend a lot of time. What has got to go right for us to get a double-digit return? And right now, I think the headwinds for Netflix are there. And one point I'd make, actually, and this is something I do, and it's a bit more of it's one thing I look at. There's 437 million shares in Netflix. Okay, that's their issued share capital, and Reed owns a whole bunch or whatever. 133 million shares traded yesterday. That's 30% of the shares in issue. That's a big number. But the question I ask myself is, are the other 70% of shareholders who haven't sold, are they happy? Are they content shareholders? And I'd argue probably not.
Tell me about Bill Ackman, because he's tell us more about him. He made headlines in the Financial Times this morning because he took a knock. He bought into Netflix only 3 months ago. He was prepared after the quarterly results to sell out completely and take a $400 million loss. Now, he must have plenty to be able to do that in the first place.
Yeah, look, he's a billionaire. He's been a very successful hedge fund manager. I'm not his biggest fan, I have to be honest. He likes to, do a lot of publicity about the positions he has. He was very short Herbalife a few years ago. I don't know if you recall, there was quite an acrimonious debate going on between him and Carl Icahn, who actually after that went long Herbalife, and then I think Bill Ackman lost $1 billion, and Carl Icahn made an absolute fortune. But the one thing that investing teaches you is humility, and I think one always needs to try and be humble and recognize your mistakes and learn from them and try not to make them again. Of course, you're going to end up making different mistakes, but as long as this is a process and yeah, so he took a $413 million hit, and we'll have to see. But you know what? He publicized. I mean, he went very public after that last purchase,
Yeah.
and so karma, I guess.
The point there was that he bought in when everybody else was selling 3 months ago in January, after the first disappointing set of numbers from Netflix, probably, well, in many years, before the latest ones, which are the worst in a decade, and tends to tell us that they're ex-growth. So you've got to now look at a different matrices. But he said when he bought in that he's there for the long term. Now, if somebody's there for the long term 3 months ago, something dramatic must have happened in these numbers, which is saying to him, hang on, the fundamentals, the underlying fundamentals of what I believed are now different. And you almost get a sense from watching the quarterly Netflix investor call on YouTube, and then reading the quarterly shareholder letter, that they're panicking, that they're trying to kind of find some way now to grow revenues now that it's starting to decline. Is that the feeling you're getting, or would that have been one of the reasons why Ackman would have dumped at such a huge loss?
I'm not sure, Alex. Sometimes first loss, best loss, but I mean, let's just be honest. Netflix still grew revenue 10%. Okay, and in the quarter they generated 800 million of free cash in the quarter. Unfortunately, last quarter they lost 569 million, and the last couple of quarters they've lost money, and so over the last 4 quarters they've lost 27 million. So this is not a disaster where the company is going bankrupt. This is just a growth company that all of a sudden people have figured out they've perhaps overpaid for growth. Okay. And I think what scared people more than the 200,000 subscriber loss was them saying, look, we're going to probably lose 2 million this year. And the point, and I have written about this in the past, I think I do worry. We've just started earnings season. We've really had the banks reporting so far, and it hasn't been amazing, to be honest, in the US. And we've seen a couple, Johnson & Johnson and Procter & Gamble have reported. The big week is next week. The big week. And I worry there are a couple of things that Netflix is showing us and Johnson & Johnson have shown us. And the one thing that investors in the US, I would make the point, that us South Africans understand that the US investors don't, are currencies. Okay. If you're living in the dollar, you've never really worried about currencies. Us living with the rands, we worry about currencies. And the dollar has been really strong. Look at the yen. I think it's down 20-something% over the last year. The euro is weak against the dollar. The pound is weak against the dollar. And you look at a company like Netflix, what's it, about 40% of its business is in the US. The other 60% are in these weak currencies. So they are the opposite of a rand hedge. Everyone used to rush and buy Sasol and all the rest, rand hedge. They're the opposite of a rand hedge. And not just Netflix, Microsoft, Google, Amazon, Apple. They are all huge international businesses. And I don't think people have factored in the currencies. Now, the argument against that is, you got to worry about constant currencies. And I go, that's just nonsense. I mean, you don't pay your dividends in constant dividends. And you can't say, stripping out the oil price, constant oil price and constant costs. So I don't think this constant stuff works. It's a short-term thing. But let's look at Russia. It's not just the lost subscribers. Let's say you're a multinational business and you've got some operations in Russia, which you've now closed down. You can't just walk away from those leases. So you're still having to pay the leases. You're still having to pay the employees. You might say, there was an FT article yesterday. I think there's still, 200,000 employees on the books of international businesses. You have to carry on paying your employees and your leases. And what about the fact that if you've been supplying Russian retailers, you haven't collected those debts yet? You can't actually collect the debts, so do you write those off? And now you've got more costs from lost Russian sales. You've got lower operational leverage from not being able to have those sales to offset against the US head office costs. So I think it's a challenge, and I think earnings for the US, for many US multinationals, are going to be quite pressured. And I think we started to see that with Netflix and Johnson & Johnson. Netflix grew revenue 10% last quarter. They grew revenue 16% year over year, and they only lost 200,000 subscribers. So that is what I think is interesting. Now, going forward, you say, okay, well, now they're going to lose subscribers because of the other stuff, and it's in weak currencies, and content costs are going up. I think it's a challenge. But so that's what I think is interesting about what's happened. It's not just Netflix; it's an insight into what's coming next week. And maybe I'm happy to come on and chat after those tech companies. Maybe I'm wrong, and I'll be like Bill Ackman. I won't have lost 400 million, that's for sure. But I'll have to eat humble pie. But there's some challenges coming for the companies, for these large US multinationals.